Joining me now to discuss the week ahead as we head into the last few days of January is Sverre Holbek, a Senior Analyst at Danske Bank in Copenhagen. Now Sverre, first and foremost, is there anything and anywhere particular in the world that Forex traders and investors should be paying close attention to next week in terms of macroeconomic data or decisions by policymakers?
Yes. First we start out with the week being kicked off in Euroland with the EU summit on Monday. There, market participants will be focusing on whether there's more details about the fiscal compact for the Eurozone. We don't actually expect an agreement on the private sector involvement for Greece to be ready to be announced for the markets on Monday, so we don't think we are going to get much more information there. There's also been some discussion about combining the ESM rescue fund with the EFSF rescue fund, in turn boosting the purchase power of the combined rescue funds. But given the statements from German Chancellor Merkel at this week's meetings, it seems less likely that that is going to happen. Overall, therefore, there is a risk that the markets will be left disappointed after the EU summit on Monday, which we expect to be not very rich on concrete initiatives. Looking further into the week, we have a bunch of economic details. Firstly, it will be interesting to see we have final PMIs coming out from the Eurozone. There were some quite positive signs when we had the flash PMIs out during this week, and we expect the final PMIs released on Wednesday to confirm the improvements seen in the flash numbers. We also have PMI data out from Switzerland, from China, also from the Scandinavian countries, and not least from the US, where we have the ISM manufacturing released on Wednesday. Finally, we have the employment report from the US coming out on Friday, so it looks like it's going to be a fairly busy week next week.
What about New Zealand and Australia? We've already seen several data releases from both of those countries this week, which showed inflation easing in Australia, and the Reserve Bank of New Zealand left rates on hold. How are those two commodity countries faring amid a slowdown in the global growth outlook?
Well, there's no doubt that sustained high global recession risks is leaving downside risks on both economies, given their high exposure to commodities and also to the Asian economies. However, we do expect that Chinese economic growth will pick up as we look further into 2012, and that is also going to lift both the Australian and the New Zealand economy. So from that perspective, there is a risk that we will see further rate cuts from the Reserve Bank of Australia over the coming months. We look, however, for the Reserve Bank of New Zealand to keep rates on hold over the coming year.
What about Canada? Canada's fundamentals seem to be holding up pretty well, and we've got several data releases out of the Canadian economy next week.
Yes, that's correct. We have a bunch of Canadian economic data. We have both the GDP, the monthly GDP release on Tuesday, and then we have the labor market data, including the net change in employment coming out later in the week, and the IV leading indicator. Basically, we see the Canadian economy holding up fairly well. That's also largely to do with the strong improvement in the U.S. economic data, and it seems like the U.S. economy is continuing to a cruising speed in 2012. And from that perspective, we also see the Canadian economy faring quite well in 2012. And that means that it's quite likely the Bank of Canada will keep rates unchanged throughout 2012.
In terms of the dollar-yen, it's been stuck in a pretty tight range for some months now. Now, following the Federal Reserve's decision to extend the period of ultra-low rates to late 2014, where do you see this pair in the mid to long term?
For now, it seems like pressure will resume on the downside. We have the U.S. Fed keeping rates ultra-low, so that is going to be a factor putting downside pressure on dollar-yen. Furthermore, we have the U.S. fiscal situation also acting in that direction, a massive U.S. current account deficit and weak external balances, as well as the still yen positive flows from the income balance. So we think that on balance we will have dollar-yen trading back lower. We do, however, see limits on the downside, given that the Bank of Japan is likely to fiercely counteract a move lower below 75. So we could see a modest decline in dollar-yen, and then looking further into 2012, we think that risky assets are going to fare quite well. we also think that data are going to continue to improve, in turn lifting longer US rates. So I think that we are going to head towards 75 on the 6-month horizon, and then that the momentum will change and that we will see higher levels in dollar-yen going towards 78 on the 12-month horizon.
And Sverre, before we draw to a close, in your opinion, how optimistic are you right now about EU leaders' ability to put an end to this European debt crisis? And also, how many EU countries, in addition to Greece, could we consider insolvent?
The past year has been very hard for the euro indeed. That said, we don't expect a breakup of the Eurozone. We think that the Eurozone will continue to muddle through simply because the economic and financial impact of a breakup would be far worse than the collapse of Lehman Brothers. So we think that the debt crisis is here to stay, but that we will not see an adverse scenario. In terms of countries that are causing concern, definitely Portugal is a source of concern, and so far we're not too impressed with the pace of reforms in the countries. So there are a few countries besides Greece that are definitely causing investors concerns at the moment.
Thank you very much, Sverre. There seems to be plenty for investors and traders to bear in mind next week in terms of market movers. Now join us next week on DukascopyTV for another week full of interviews, press reviews and targets in focus. Have a great weekend. Goodbye.